Hello everyone, welcome to MAPS Group project. The entity we choose is Flight Center. Let's start from question 1. The group's principal continuing activities consist of the selling of international and domestic travel. There were no significant changes in the nature of the group's activities during the year of 2009. Question 2. The consolidated profit after tax attributable to the shareholders of the parent entity for the 2009 financial year is $29,114. Question 3. The CEO is Graham F. Turner. His remuneration in the 2009 financial year is $299,580. Question 4. According to audit report, it is found that the PricewaterhouseCoopers is the auditor for Flight Center Limited. They have audit responsibility to express an opinion on the financial report. They conduct their audit in accordance with Australian auditing standard. The financial report of Flight Center Limited is in accordance with the Corporation Act 2001. From Note 34, the parent's total audit fee for the 2009 financial year is $771,948. Otherwise, the consolidated audit fee for the group is $2,054,401. Question 5. The Note 39 subsidiaries declared 46 controlled entities in the group. The 43 subsidiaries of these are owned 100% by the Flight Center Limited. There is only one company which the Flight Center Limited holds less than 50% equity. That company is FCM Travel Solution. In 2009, the group lost control for 5 subsidiaries, which are Advanced Trader Private Limited, FCM Travel Solution Private Limited, Escape Travel Limited, Great Holiday Escape Limited, and Student Flight Limited. At the same time, the parent reduced 50% equity holding from Paddle Group Private Limited. 3 new subsidiaries set up in 2009, which are AIT International Ticketing Limited, Britannic Travel Wholesale Limited, and Flight Center Wholesale Limited. Most of subsidiaries of Flight Center Limited are foreign entities. Question 6. The Flight Center Limited has 2 associates, and the entity owns 26% and 56% ownership interests respectively. Other than associates, the entity also invests 4 joint ventures. All of these jointly controlled entities owned by the group are more than 50% interests. Question 7. Flight Center have no jointly controlled operations and assets. Question 8. At 30 June 2009, the consolidated goodwill of Flight Center Limited is $330,803,000. For the purpose of impairment testing, goodwill is allocated to cash-generating units, which are identified according to relevant business and country of operation. The recoverable amount of CGUs have been determined based on value in use calculations. This calculation uses cash flow projections based on financial budget approved by management and cover a 5-year period. The growth rate does not exceed the long-term average growth rate for the business in which the CGU operates. In 2009 financial year, the impairment of goodwill is $3,806,000. Question 9. Flight Center Limited and its wholly owned Australian controlled entities implement the tax consolidation legislation as of 1st July 2003. The head entity Flight Center Limited and the controlled entities in the tax consolidation group continue to account for their own current and deferred tax amount. These tax amounts are measured as if each entity in the tax consolidated group continues to be a standalone taxpayer in its own right. In addition to its own current and deferred tax amount, Flight Center Limited also recognizes the current tax liability and the deferred tax asset arising from unused tax losses and unused tax credit assumed from controlled entities in the tax consolidated group. Asset or liability arising under tax funding agreements with the tax consolidated entities are recognized as amount receivable from or payable to other entities in the group. Any difference between the amount assumed and amount receivable or payable under the tax funding agreements are recognized as a contribution to wholly owned tax consolidated entities. Question 10. Flight Centre Limited and its controlled entities operate predominantly in one business segment, the sale of travel and travel-related services and products. The group is organized globally into major areas. As disclosed in Note 41, Flight Centre operates in Australia, North America, United Kingdom, and others. Its primary reporting format is geographical segments. Segment information is prepared in conformity with the entity's accounting policies as disclosed in Note 1 and Accounting Standard AASB 114 segment reporting. Segment revenue, expenses, assets, and liabilities are directly attributable to a segment, and the relevant portion that can be reasonably allocated to the segment. Segment assets include all assets used by a segment and consist primarily of operating cash, receivables, inventories, property, plant and equipment, and goodwill, and other intangible assets, net of related provisions. Refer to Note 1. The purchase method of accounting is used to account for the acquisition of subsidiaries by the group. The purchase method of accounting is used to account for all business combinations, regardless of whether entity instruments or other assets are acquired. Cost is measured as the fair value of asset given, equity instruments issued or liability incurred or assumed at the date of exchange, plus costs directly attributable to the acquisition. AASB 3 defines the application of purchase method. The objective of AASB 3 is to outline how an entity accounts for a business combination. It is applicable for annual reporting period beginning on or after 1st January 2005. Question 11. Investment in associate account for in a consolidated financial statement using the equity method of accounting. After initially being recognized at a cost, the group's share of its associate post-acquisition profit or losses is recognized in the income statement, and its share of post-acquisition movement in reserves is recognized in reserves. The cumulative post-acquisition movement are adjusted against the carrying amount of the investment. Interest in joint venture entities are accounted for in the consolidated financial statements using the equity method. Under the equity method, the share of profits or losses of the joint entity is recognized in the income statement, and the share of movement in reserve is recognized in reserves in the balance sheet. AASB 128 defines the application of equity method. The objective of AASB 128 is to prescribe the accounting for investment in associates and joint control. It is applicable for annual reporting period beginning on or after 1st January 2005. In the parent entity account, purchase method applies to Flight Centre Limited, and investment in associates are accounted for in the parent entity financial statements. Use the cost method. Interests in joint venture entities are carried at a cost by parent entity 2. Question 12. From 15th March 2009, Flight Centre no longer had the practical ability to control FCM Travel Solution. Flight Centre maintained 56% ownership of FCM Travel Solution and accordingly accounts for the investment as an associate. On 2nd of February 2009, the third party obtained an option to purchase a 25% share of Backroad. This purchase and option over shares in Backroad by the third party meant that from 2nd of February 2009, Flight Centre had a joint control over Backroad and would account for the entity as a joint venture. That's it for our group project. Thank you for your listening.